A legendary investor. His name's Warren Buffett. And he was asked years ago if there was one thing that you could look at to determine whether stocks were cheap or expensive, what would it be? Hi, everyone. My name is Mike Minter, and I'm doing a three-part series on the S&P 500 that I call the $30 trillion truth. I am a certified financial planner. I've been in the industry for over 25 years, and I want to make it clear that these are my views and not the views of Main Street Financial Solutions, where I am a partner and also an advisor. So this is part two of my series that I call Where Are Stocks Now? And it pretty much focuses on valuations. So we're going to hop right into it. And the first chart here is the S&P 500 Shiller-Cape ratio. And the reason why I use this chart is because I think it's one of the most accurate charts over the long term, telling you when the stock market is under or overvalued. The easiest way to look at this chart is 10-20. So we kind of put in the lines here for 10 and the line here for 20. When you get to a valuation of 10 or below, it's normally a very good time to invest your money into stocks, and returns are normally going to be very strong. Conversely, if you get above 20, that could be where you're taking a little more risk and markets could potentially not do as well over the long term. So when we look at it and talk about it in just normal business situation, if you were going to buy a company of mine, I sell $100 million, and after my cost of goods sold and paying my employees, I net roughly $10 million in profits or earnings at the end of each year. And I've been doing that pretty consistently. So if you're going to buy my company and you're going to buy it at a 10 multiple, you're going to pay me $100 million. So that's going to be 10 times my 10 million of profits. If you buy me at a 20 multiple, you're going to pay me $200 million. So 20 times my 10 million in profits. So when you look at this chart, it is showing you that for the S&P 500, you are now paying $33 almost for every $1 of S&P earnings. So in other words, going back to my example, if I'm the S&P 500, it doesn't matter what company it is, but let's just say that I'm the S&P 500 and I'm making $10 million. Well, if you're going to buy my company today, this chart is showing that you are going to pay me $330 million for my company. Now, the problem with this chart is it's not a market timing chart, okay? So when valuations get very cheap, like they did in the early 1920s, I mean, you could have been making investments here and you would have done very well, but you would have continued losing money for a good period of time here until the markets went up a whole lot. Same thing with here, in the late 20s, before the Great Depression. You would have lost a lot of money if you sold right here because the markets ran for another couple of years. When you look at a chart like this, and clients of mine know this because we've been talking about it for a long time, it's not a market timing chart. It doesn't tell you when, but it does tell you how far. And what I mean by that is, yes, markets can continue to keep going up once it gets above 20, but it also tells you the further it gets above 20, the potential losses that you could take if and when things turn. Same thing up here at the top of the tech bubble. These are the potential losses that you could take. You know what? You buy down here and markets keep going lower and lower and lower. Yeah, there's a little bit of pain there for a little while, but then you get rewarded for being patient and buying at those levels. The next chart is a chart that I have been using for years because as I've kind of seen valuations, I mean, the Shiller-Cape ratio isn't the only one. I mean, you can look at that other price to sales ratios, price to dividends, price to book value, price to cash flow. They are all historically very high. So as an advisor, when you look at that stuff, it makes you want to be a little cautious for your own money and your client's money. But at least a chart like this, when we pushed interest rates to basically zero during this whole period of time, it would say This is the S&P dividend yield divided by the Treasury bill yield. It would say, hey, stocks are undervalued relative to T-bills because you're not going to get any yield on your T-bill right now. I mean, back then it really was close to zero. I mean, you were getting 0.2, 0.3. I don't even remember what it was, but it was not good. And at least stocks, compared to history, it wasn't great, but it was still a close to 2% dividend yield. So you could look at it as I'm getting paid more in dividends to own the S&P 500. I'm going to get taxed at a qualified dividend rate, which is lower than what I would have to pay on interest. And I have the potential for growth being in the S&P 500. So I could look at this chart and say, you know what? This chart makes me feel a little bit better about justifying valuations and where they were, because where else are you going to put your money? But now, with where interest rates are today on the T-bill, I can no longer even use this chart to justify current valuations. My last chart in this segment, this is the quickest segment, is stock market capitalization as a percentage of nominal GDP. A legendary investor, his name's Warren Buffett, and he was asked years ago if there was one thing that you could look at to determine whether stocks were cheap or expensive, what would it be? And he said stock market capitalization as a percentage of GDP. So that's what this chart is. So stock market capitalization is just the share price times all of the shares outstanding for all the companies in the S&P divided by nominal GDP, which is everything that is produced in this country. The norm since 1929 was 69.5, and today for the S&P 500, it's 156.8%. And if you're going to use all of the companies, publicly traded companies, it's 183.4%. So does not look like things are what he feels are cheap in this type of environment. And that probably explains why he has a record amount of $190 billion of cash on his balance sheet. So when we talk about stock market capitalization, again, what a company is worth, Berkshire Hathaway, his company, Warren Buffett's company, is worth roughly $900 billion. And he has $190 billion in cash. So pretty much over 20% of his company is just sitting in cash. Now he has a big shareholders meeting once a year in Omaha, Nebraska. And it's a big deal. It's a big event. It's on the weekends. Shareholders go. All of the companies that are in his portfolio are normally there, give out free stuff, do a Q&A session. And when they were doing the Q&A session, one of the shareholders did ask him, so Warren, why do you have so much cash on your balance sheet? And Warren Buffett basically said, because I can't find anything attractive enough to buy. That should say something. Part 3 is going to be on why you should be concerned. Thank you for listening.